Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Happy Thursday. Welcome to the dog days of summer. Sports calendar's rather lacking if you ask me. All the golf majors done. All we have is mid-season baseball and the Cubs in the gutter. We're trying to help you through these slow days with a bunch of great episodes coming up, with Ben Eifert, Surgify, Augustin LeBron, and Braj Agrawal all coming up to make it an awesome August. On to this episode, where we got to sit down with fellow Chicagoan Brian Portnoy, who authored a few books, How I Invest My Money, Geometry of Wealth, and The Investor's Paradox, before launching a unique business focused on helping advisors and their clients achieve funded contentment, as he calls it. We get into his non-cousin Dave Portnoy, YOLOers needing to embrace agency, how crypto deludes people into thinking it's both an investment and savings and protection, and whether behavioral finance is fluff or function. So much more. Send it. This episode is brought to you by RCM's Managed Futures Group, which will, any day now, I swear, release their semi-annual Managed Futures rankings covering trend, ag, energy, big firms, small firms, and everything in between. Head on over to rcmalts.com and pop in your email to get the rankings as soon as they're released. And now, back to the show. All right, hello everybody. We're here with Brian Portnoy. Welcome, Brian.
Hi.
So I'm here in Roscoe Village, and you're just north of me in North Center, I think, right?
That's right. I'm just on the other side of Irving Park Road.
We should have done this in person. Here we are sitting in our homes when we could have been sitting across from each other live.
I offered drinks if you...
You did. That's my fault.
I'd rather be drinking, or I'd rather be drinking with you.
Yeah. I don't know how to do the live pod on the Zoom, right? Like, could you just set up two Zooms, I guess? Two computers next to each other? Let's figure that out for next time.
Next time.
So wanted to briefly touch on your surname there and clear up that you aren't related to David Portnoy in any shape or fashion. I think
my Twitter bio says not Dave's cousin.
Yeah, there you go. But that kind of dives into, in my mind at least, what you're touching on, what you're doing a little bit lately, of like talk about what he was doing and YOLOing trades and all that good stuff, and how it relates to kind of what you were doing.
Yeah, it's interesting. I've never really thought about it in that regard, but yeah, I mean, he's a bullshit artist. I don't know if I'm allowed to swear on your podcast.
Yeah, go for it.
And I don't think that I am. He's a pump and dump guy. He's an entertainer. He's very talented in that regard, but he did a nice job building out Barstool, and then he sold it and made some 9-figure sum, and himself was YOLOing a bunch of things, and talked about it. And there's a lot of young men who are very open to the Pied Piper effect. There's such a level of dislocation and anomie in our society, and that has certain, I think, nefarious political implications. But also, in terms of GameStop and some of this crypto nonsense, you've got certain ringleaders, Pied Pipers, like the other Portnoy, I'm the real Portnoy. So
you're right.
The other Portnoy, building up a fan base by saying, hey, this stuff's on a rocket ship. Elon is a much bigger example of somebody who just says things, and some people attach to his every word.
And so if you had written the book today with all of that GameStop and Portnoy and all that stuff happening, would there have been a mention? Would there have been a section of like, hey, don't fall for this BS?
Well, if the book in reference is The Geometry of Wealth, no. The first book, The Investor's Paradox, which came out in 2014, it very well could have shown up there, because that was a book about investing per se from a behavioral finance perspective. The Geometry of Wealth had an investing section, so in The Investor's Paradox, it could have very well been a good example of how not to conduct yourself, or maybe just a cautionary tale.
Yeah, and it's weird for me because I haven't seen any, like, right, there's all this behavioral stuff, FinTwit's full of the behavior, but you don't see much that talks about that addressing these YOLO guys of like, the world's unfair. This is the only way we're going to get ahead by risking and over risking an amount, whether it be in crypto, whether it be in GameStop, right? There's that kind of, people have kind of pushed that aside of like, well, you can't blame them. They're not going to be able to get ahead anyway.
Yeah, I'm not a big fan of being a victim.
Yeah.
There are people who are born into pretty, lousy circumstances, and they could complain or not complain. But my sense of the group that likes to play the victim card, and that the only way they can escape their bad lot in life is to YOLO GameStop or to load up on Solana or something. It's like, just stop. Like, you're just full of shit. Like,
right. It's
like
just an excuse.
Yeah, like, and maybe I think I am entering my old man shakes fist at clouds phase, but like, yeah, embrace agency. Like, going way, going back to the reason I showed up in Chicago in the early 90s, which was to get a Ph.D. in the social sciences. And I taught Smith and Marx and Durkheim and Weber and all these things to undergrad. So I spent a decade thinking about structural versus agency-based causes for social phenomena. So I'm wide open for like structural problems. Marx was maybe a shitty economist, but a pretty good historian and sociologist. And so, I'm all in for structural explanations and the lack of agency one has in a cruel, cold world. But these guys push it too far. It's like, just take responsibility for your stuff. Go make a living. The world's an amazing place. There's so much opportunity, and if you, with a healthy mind and body in your mid-20s, think that the only thing you can do to get ahead is to buy crypto, then you stink.
But do you think it's an ingrained, like it's become a behavioral bias, like a behavioral roadblock, or it's just an excuse?
I think it's an excuse. I mean, you and I could both wrap everything in fancy language and make it sound good, but it's just an excuse not to take care of your own stuff.
So speaking of crypto and like, so even if you had that excuse, you're giving that excuse, but all those poor souls that had their money in Celsius, that had their money in all this stuff, like, how do you view that in terms of how you, right, at shaping wealth, and like, no, that's not the way to wealth. What are you guys doing?
Well, I mean, specifically, we're not doing anything. I mean, we don't do investment counseling. I think so. We do base a lot of our coaching on the 7 dimensions of money life: earning, saving, spending, borrowing, giving, investing, and protecting. I think investing is probably the least interesting / easiest to solve for of those 7 dimensions. So, what you're talking about could be indicators of certain, client behavior that advisors would want some counseling on. And in fact, we did a really fun coaching program or coaching presentation maybe a year ago called Bitcoin Blues, which wasn't about Bitcoin. It was about FOMO and where do we get this fear of missing out, and then JOMO, what is the joy of missing out, and that became a kind of a coaching seminar for financial advisors.
JOMO is like the Americanized version of Schadenfreude or whatever that word is.
Schadenfreude.
Schadenfreude, yeah.
Yeah. You don't want a Russian Jew named Portnoy quoting German culture.
Okay.
It's not a good.
So you came JOMO.
So yeah, I didn't make up JOMO. Somebody came up with JOMO, but JOMO is the Schadenfreude is the joy you receive from others' misery. No, JOMO is just, oh, okay. I didn't go to Lollapalooza, and boy, am I happy I wasn't in that crowd. Like, I could have gone, I didn't want to go. I felt like I should have gone, and like, oh God, it was 95 degrees and humid and packed, and the Foo Fighters canceled, and it was going to be awful and whatever. So, but JOMO is just appreciating that you can't do everything, and you can make a choice to avoid things and just sort of be present with yourself or people around you, and that's a good thing. But back to your question about crypto, there's levels. One is the herding behavior, which we can observe from a macro point of view, and that's normal. I mean, probably the most important thing we can say about humans is that we are social creatures and that we are deeply hardwired for the need to belong, to be part of a group. So when you dig into evolutionary psychology, when you dig into history, you can see that that sense of connection with others is about as important a topic as you can get into. So in-group versus out-group dynamics and finding your tribe, so to speak, like super important and not irrational, not trivial, like deeply important.
And probably could be argued as hard as ever in today's world, right?
Well, it's, yeah, because we now have access to what every, we have eyes on what everybody's doing. There's the old JP Morgan line that nothing corrupts your financial judgment more than the sight of your neighbor getting rich. And
Yeah.
the thing today, because of LinkedIn and Twitter and Snap and Facebook and TikTok, is that everybody can see what everybody's doing. And I think one of the reasons that arguably society is on tilt is because we are being confronted with so much stuff, and there's headwinds and tailwinds. It's going to encourage certain positive tribal behaviors. It's going to encourage certain negative behaviors. We're in it. It's really kind of hard to assess it. It's hard to imagine it going away. I don't think this genie goes back in the bottle. So the fact that because of the way information technology can spread instantaneously, you see things like crypto, which, clearly I've made some negative comments in the last 5 minutes. It is what it is. And there could be potentially some positive things about it. But, guys latch onto it, and they see other guys latch onto it. And that's that natural herding behavior, that natural bias toward finding confirmatory evidence and being deeply uncomfortable, physically uncomfortable with evidence or news that contradicts your priors. Like that's really real. There's another level though that we should flag, and you're the investor, not me, or I used to be an investor. And that is that, you looked at some of these platforms that were offering 15 to 20% yields on cash. And it's like, come on. All right, if literally my 80-year-old mother was confronted with that, and she doesn't know anything about anything, she could get sucked into that, and that would be a shame. But if you are a kind of a sentient adult, and you are being offered 20% yields on something, and you're supposed to think that that's normal, let alone safe, then again, it gets back to our topic of agency. Like, have you done any work? Have you done any diligence? And the answer has to be no.
And go back to your 7 pillars, or what'd you call them? Seven
dimensions of money
dimensions. Sorry.
Earning, saving, spending, borrowing, protecting, investing, giving.
So yeah, I think what's interesting to me in light of those 7, right, is like crypto for a lot of these young guys marks off a lot of those boxes. Like you're just saying, oh, this can be my earnings. This can be my savings. This can be my protection.
Yeah.
And this can be my investment, right? Yeah. So it's like, cool, crypto just checked off 4 boxes. I get all this yield. I get this protection against inflation. I get, right, which is narratives all the way around. But it's just interesting to me in light of kind of what you're doing on a day-to-day basis of like a lot of that fits that profile in their mind. So they're like thinking they're doing the right thing.
I've never thought about it in those terms, but I'm gonna have to do something with that. The other layer here I'd put on is that something I've been thinking about are what I call identity assets. meaning that, things that we own that give us meaning and purpose and identity. And, the crypto community is clearly defining their identity in part through digital currencies. Like it's meaningful to you. I mean, there's far less salacious examples. You could think about a house you own or a building you own, and economically, maybe the right thing to do would be to sell it or refurbish it or do nothing, but you act differently because the building or the home has a certain meaning to you. So we source parts of our identity through financial assets. I don't think there's anything new with that. And in fact, going to the traditional behavioral finance literature, we have the so-called endowment effect, which is that the moment you own something, you value it more than the moment before you owned it. It's more meaningful to you. So that's we've known about that for a long time. But like the kind of tip of the spear here is that for like highly volatile, controversial assets, to tie your identity to them can be highly volatile.
Yeah. We used to work with an RA who called it financial furniture. He'd be like, right, I have these clients in Atlanta. They have the Coca-Cola stock that's been passed down from their grandma to them, to their kids. And it's financial furniture over there in the corner. Like, you can't sell grandma's couch. What are you doing? That's got to stay over there in the corner.
That's exactly right. Yeah. It's, try to put that into an efficient frontier calculation.
Right.
Like you can't. And that's maybe a pitch for behavioral advice, because like if you can't figure out what that is, or if you just say, well, that's irrational. And at Shaping Wealth, we're remote only because I've got one partner in Atlanta and then two partners in Europe. On our virtual wall, there's the word irrational with a circle and a line drawn through it. Like the concepts of rational versus irrational behavior are not something we are allowed to talk about because they actually undermine good conversations about money and decision making and habit and meaning. We just talk about normal. In fact,
dig into that more. So you're saying if I'm like, oh, that's irrational, why would she ever buy that?
Yeah.
It's not helpful. Why is she buying it?
Well, not only is it unhelpful, it's harmful. It's harmful in the sense that when you pathologize normal human behavior, you become not just kind of analytically judgmental, you can become personally critical. Irrational is a fancy word for stupid. I mean, like, he's acting irrationally, i.e., he's an idiot.
Right.
Like, why would he do that? One of the things that we run this coaching program at Shaping Wealth, and one thing we talk about is we talk about a bunch of things. We talk about listening, and we talk about validation. We talk about awareness, not only self-awareness, but awareness of, the person across the table from you, that, empathy, which is a very complicated, multidimensional phenomenon. And so, when, the grandson won't sell grandma's Coca-Cola shares, and it would be very beneficial to them financially, from a balance sheet point of view, numerically, to sell them, and they won't. I mean, the advisor is not going to call that person stupid, but they might think, oh, God, that's really a bad decision. And we would counsel differently, which is, well, why don't you take the time to listen to what's important to them and why they value the things that they do, and have an authentic conversation that starts there and builds from that in terms of the life that they want to live and how something like grandma's Coca-Cola shares fit in, versus kind of isolating this asset, calling it the irrational piece and saying, the hell with it. It's only 5% of their portfolio and we're not going to deal with it. There's just a different door you can choose to walk through as a behavioral advisor. But you are sort of compelled to jettison the idea of irrationality.
what do you say to people who'd be like, that's just a bunch of fluff, right? Like I would, well, I'll start with what percent of advisors these days are moving towards this direction of moving towards behavioral conversations and addressing biases versus just like, hey, here's the pie chart. You need to make sure you match up in this pie chart.
I mean, I'll round up and say all of them. I mean, the idea that an advisor is going to add value through their investments is a joke.
Yeah.
I mean, it is.
Yeah. Well, I will say, like, is this person sitting in Racine, Wisconsin, the smartest person in the world to manage my investments, right?
That's right. And
sorry for all you Racine listeners out there.
I've been to Racine.
Yeah.
Nice.
Or Racine if you are in a league of their own movie.
No one cries in behavioral finance. So no, I mean, look, Jeff, the clear trend that we're seeing, and of course I'm talking my book, but I built my book in light of the trend, not the opposite.
Yeah.
Which is that there is a full-blown movement among wealth management firms from the individual independent RIA all the way to the wirehouses to embrace behavior broadly defined. And I'd stress that, like, behavioral finance 1.0 kind of sees, the use of Kahneman, Tversky, and Thaler and those dudes as, the source of different tools and tricks you can play to nudge people and label biases and do all that. I have a different perspective on behavioral finance 2.0, which just starts with the premise that behavior is gravity, not a tool. And by gravity, I mean that it's everywhere. There's no not behavior. Like there's no not gravity. There's no not force that's keeping me in my chair right now. And so when you embrace that, like, there's no step of the financial well-being process, there's no step of the financial planning process, the investment process, that doesn't implicate some dimensions of cognition, perception, decision, habit, you name it, then you say, well, everything's behavior. And then how do you accommodate that force? How can you maybe bend it a little bit to suit your needs or your client's needs? And so the wirehouses have chief behavioral officers, which are 7-figure gigs. Independent RIAs are working with us to receive coaching and content. The vast middle ground of larger independent firms, the $5 to $50 billion RIAs, they're working with us. The independent broker dealer space, the 50 billion, to $500 billion, $1 trillion IBDs, they're working with us. I mean, we're just getting going, so we've got smatterings here and there. Yeah. But like I have these conversations every single day with not only individual advisors, but from the top down, the heads of advisor development, as well as the heads of learning and development for the firms overall. And so how to integrate behavioral insight into the entire financial planning process is the ball game right now.
And what, for all those groups you mentioned, what's their end game? It's another piece to attract clients, or it creates a better outcome for those clients in the end?
Well, it's both. I mean, you start with your existing clients and you try to retain them and provide an overall better experience. It's one thing to have a conversation about whether you have an optimal portfolio. It's another conversation to understand how money is fitting into a meaningful life, however you choose to define that. The first conversation is narrow, and I think a fair bit of theater in terms of whether or not the guy in Racine or the gal in Albuquerque is building a better portfolio than the person in Fresno or Tallahassee. The second conversation requires a fair amount of contemplation, and I would argue, learning to really know how to have those conversations. It goes beyond being a good guy and having some common sense and being ethical. There are some deep-seated human tendencies that we all have that are worth understanding. We talked earlier about kind of our disposition to belong and to be connected, and that has a variety of implications for money life. And beyond. So, what is the payoff? Well, I mean, part of what and so because we're early in our business development, we're kind of mapping to the crossing the chasm type dynamic where innovators and early adopters are kind of who we're working with. And right now we're kind of figuring out like the early majority piece as we get to bigger firms that seem to be broadly interested in what we're doing, but have to figure out specifically like how to work with us. There's an element of, well, this is the right way to be. Like, if you're going to be a financial advisor, you should go beyond trying to build a good portfolio. You should go beyond just building a financial plan. You should engage in planning. So move from noun to verb on plan, and then figure out, well, what is a goal, which is one of the most complicated and misunderstood ideas in our industry. But like, how do you form and achieve goals? How do you keep on track? How do you stick to the plan? How do you make decisions and form habits? How does all of this relate to your sense of contentment in the here and now? And more broadly, how does that then create certain conversations between husband and wife, parents and children across a multi-generational stack? I mean, we're working with a very, very large private bank now, one of the largest in the world. And they are, I was going to say struggling, but they're contemplating how to have better conversations about money across 3 or 4 generations now, because they are observing that if you do the old school stuff on, in the wood paneled boardroom with a stack of papers and trust documents and all the portfolio stuff, it just leaves the adult children and the grandchildren numb.
Yeah, they say forget it.
And so, well, how do you broaden the conversation? It's actually not obvious. I think that's why we are growing in the way that we are.
And you think a piece of that ties back into I hate to use the term ESG, but it's sort of ESG, right? Does some of these things of like, well, I want to have control over what my money is invested in, or I keep coming back to investing. Sorry, and that's only one of the 7 dimensions, but you know what I'm saying? Is that part of that whole picture?
Yeah. So, ESG is an example of something much bigger, which is, some sense of context, or purpose or meaning. So, I whatever opinions I have about ESG, they're ill-formed, but I would say I'm a huge fan.
Right, I'll reframe of are you saying people that once they get this concept, oh, okay, I want to fulfill these goals in my life with my wealth.
Mm-hmm.
One of those goals is to feed hungry children, whatever. But if I'm doing that, and at the same time, part of the thing that's generating the wealth to do that is taking food out of hungry children's mouths, right? Does it get down into that granularity? I don't know the company that's taking food out of children's mouths, but if there were one, right, would it be like, okay, we got to get that out of the portfolio?
Yeah, I mean, I'm trying to think like the best way to like frame this, but so let me step way back and say that I wrote this book 5 years ago, published 4 years ago, The Geometry of Wealth. And the main thing, page 1 was, well, there's a difference between being rich and being wealthy. And being rich is the quest for more, which ultimately is this hedonic treadmill that you can never really get off of. Like you have 10 million bucks. Well, okay, then you want 20. You have 20, and then you want 40, and you're just on it. And
right. George got a jet. We need a jet.
Yeah. I worked at a firm once where the lead guy had his own jet, and his partners had to share a jet, and like they were pissed.
Yeah. Right. Versus if you're coming from your 22 in a new place, like, hey, if we all shared a jet, that'd be awesome.
Yeah, exactly. Well, if we didn't have to share a bedroom, because rents are so high. Like, before you get to a jet, how about you get your own bed? So there's the quest for being rich, which is fine. It's not as bad as I'm making it out to be. There are certain elements of more that are quite good, but then the other angle, the fork in the road, rich versus wealthy. I coined this phrase funded contentment, this idea that true wealth is the ability to underwrite a life that's meaningful to you, however you choose to define that. And, so underwrite a meaningful life. It's deliberately loaded a phrase. And one of the things, so I was in your world for 15, 17 years, mutual funds, hedge funds, Morningstar, Mesirow, bunch of firms here in Chicago, a big national investment firm where I was where I did a bunch of content and behavioral coaching things, but, worked on, understood the investment side to it as well. When I say funded contentment is the ability to underwrite a life that's meaningful to you, the burden is defining the meaningful part.
Yeah.
Okay, like what matters to you? And it's your business, not mine. I set out a pretty robust framework for helping people define what's meaningful to them, a bunch of mental models on that. But then once you have some sense here in the moment, and we change and adapt over time, but here, this is what's really important to me. It's just not my goals, but it's my values and my purpose. You can then secondly ask questions about, well, how do I afford those things? And in some cases, it might be that they're free or close to free, and that the really good things don't really cost a lot of money. It might be that they cost a ton of money. Maybe what's important to you is supporting the environment, or some other cause, or it's just supporting your family members. I mean, my wife and I are in this sandwich generation where we help our parents and we're raising our kids, and it's not easy.
Yeah.
So funded contentment to me involves, it's not happy, but it's still fulfilling idea that we have a balance sheet that could support, 3 generations, our parents, ourselves, and our kids. That's not fun,
No,
but it's meaningful.
right.
And so the point is, it's my business, nobody else's. What my sense of a meaningful life is, I feel an obligation to certain people in my life, and it's important to me that I do that, right? And so once you define what's meaningful to you, you then figure out the money stuff. And the geometry of wealth is a model for doing that. So, it's circle, triangle, square, defining purpose, setting priorities, making decisions in an iterative loop. And that iterative loop of purpose, priorities, and decisions is my recipe for achieving funded contentment. That then, I turned that book into a coaching platform called Shaping Wealth, which is the company I run with a few other people.
What if my funded contentment's owning an aircraft carrier?
Would I think the Secretary of Defense
Yeah.
require a phone call?
Yeah, exactly. How do we get there from here?
That's an interesting. I mean, we live in the same neighborhood. I'd like to see what's parked outside your
Yeah,
home
exactly.
right
How do I get there? And then do you keep running into people like you, as we get older, or just people are thinking about it more of like the most valuable thing that nobody can buy is time, right? So to have that, like, funded contentment would be just to have as much time as possible, which to my brain goes like, cool, I could invest in that friend's restaurant and this private equity thing and this thing over here, but each one of them is going to take some portion of my time.
Yeah.
As I'm laying out that framework of like, okay, sounds great. Maybe I make an extra 2% a year, but is that 2% worth my time?
Right. Or investing in your friend's restaurant maybe, restaurants are pretty risky, but maybe you just want to support your friend and you hope you just get your money back. Or, if you support your friend, but you underperformed the market, whatever that might be to you, by, 500 basis points, might you say, oh, that was worth it because I got to support my friend. I got like the cool factor of owning a little piece of this restaurant and getting a free drink at the bar and seeing people I know. I still made some money, but not as much as I would. This is where, expectations management, and which to me is alpha, the real alpha is meeting or exceeding expectations. That's where that, fits in. But it's like dealer's choice, like whether it's, owning a restaurant or an aircraft carrier. This has kind of gone in a strange direction. I don't
Yeah.
Clearly, those drinks that we were scheduled to have with Lish have to happen sooner rather than later now, because I got to hear what's on your mind.
Yeah.
Um,
And here, what just popped into my mind, oddly too, of that movie Hitch. You ever see
yep.
that with and like, did you come up with this all after, right? She's the heiress in the boardroom and they're trying to give her all those papers you're talking about.
Yeah, I hadn't
And
thought
she's
about
like,
that.
no, I just want to support my friend's art gallery. Like, I
Yeah,
don't, and they're like, no, no.
yeah.
And
The
Albert Brenneman, that was, what's the actor's name?
yeah, the guy from King of Queens.
Yeah, exactly. That's a good show.
Um,
Go check it out if you haven't seen it, listeners.
yeah, yeah. Is this the beginning of a movie pod? I feel like you and I could
Yeah, let's
do
do
some
it.
damage on that.
Yeah.
Um, yeah, the vision statement for my company, and I don't know who listens to your podcast, but it could be some kind of steel-eyed hedge fund managers, so maybe they think all of this is woo-woo, but like I really believe it. And the vision is funded contentment for everyone. If we can help people understand wealth as a mindset as much, if not more, than a number, then we can help people lead more fulfilling lives. And financial well-being is actually just a subset of a broader vision of a life well lived. But what I'm doing with my partners is trying to take a little bit of responsibility for that one piece and effectively helping people speak the language of money. Money is a language in which no one is fully fluent. It's the hardest thing to talk about. The American Psychological Association does surveys on this every year. It's the most stressful, hardest to talk about thing, more than sex, money, politics, religion,
Yeah.
divorce, you name it. And if this were just a numeracy problem, it would have been solved a long time ago.
Do you think there's a piece there that we need to like massively invest or make a priority to teach kids sooner? Teach them in
Yeah,
the school, like
yeah,
teach them that language sooner. But you're also saying like the language differs, right? There's one language and a gazillion dialects because what matters to each person's different.
yeah. I don't think it. So the problem is dire, but I don't think the way that it's as dire in the direction that you just painted it in terms of the dialects, meaning that um, uh, youth financial literacy, which is something I've been involved with for years. It's getting marginally better, but it's still, despite massive efforts and massive resources, in no small part because in the US at least, we've got 50 different education systems. And so you've got 50 different situations to solve. But globally, like there's a ton of data, and Anna Maria Lusardi, who's the lead scholar globally on this on financial literacy, like the data is overwhelming and not good, like how bad people are. And it's because like in fourth grade or eighth grade, we teach people, to answer the question, what is money? And we say, well, it's three things. It's a store of value, it's a unit of account, and it's the third thing. It's
Yeah. Method of exchange.
yeah. I mean, so we see it as this purely economic numerical transaction when in fact it's kind of a window into who we are. It's just it triggers every important emotion that courses through us: the greed, the fear, envy, joy, hope, despair, happiness. I mean, all of those are triggered by money in one way or another. For most of us, just about every day. So I do think that there is a shared vocabulary that can be created that really already exists, and it's an execution problem more than a conceptual problem of how to have this conversation with younger folks, starting when they're 10 or 14, but certainly by the time they're 18, and just getting them up to speed on like, okay, what's at stake here? Like, what are we talking about? And, sort of the financial literacy as part of an economics curriculum is the first step in a very wrong direction. It should be more, part of the humanities.
Yeah.
And understanding money as a social institution that was created just about 6,000 or 7,000 years ago. So the human brain, as it exists now, it's about 130,000 years old. Money came along like 125,000 years later. And we've been out of sync ever since. So talking about these things is really hard, which isn't to say unsolvable. It's very solvable. It's very fixable. But you need to approach conversations about money with a particular mindset.
And I could argue we've lost ground, right? Because you have Robinhood and some of these crypto ads and things that are happening there of just like we're pulling back, like the whole risk side of the brain, money brain is being erased. Right. When Robinhood like throws confetti on your screen when you did a trade and whatnot.
That's right. That's right. I mean, yeah, we're sort of tweaking, some of that stuff that we prefer not, that I think you and I would prefer doesn't get tweaked. But yeah, the confetti when you make a trade, and like one of the big trends, and this is little to do with you or me in terms of what our day jobs are, but when you think about the demise of defined benefit plans and the rise of defined contribution and what that's done for the democratizing of money and investing, and democratizing, has a nice like halo around that.
It sounds great.
It sounds great, but we know what's happened with people's ability to navigate their 401k plans, their SEP IRAs, their 403b plans. Like it's kind of a mess.
Well, it takes away the safety net, basically. It's like, okay, now you're doing the high wire act with no net. Good luck.
Yeah, and Americans to an extreme fault are observed with freedom. I promise I won't get political on your podcast.
Yeah,
but like
go for it. You're welcome.
Yeah, no, just freedom. I mean, Jesus, people, what a crude understanding people have of what that means. But well, so now we have all this freedom with our investing lives, and it's just been like this shambolic mess of people not participating, not saving, keeping money in a money market account instead of actually putting it into the market and letting it grow over time, pulling money out when things get rough. There's all these examples of our independent, our free retirement system, freedom-based retirement system not being particularly effective.
So I'll pivot off that and say, so if we still had those pensions, those groups managing the money for us, how do groups like that avoid these behavioral biases and work within such a framework, right? Because I'm sure you would agree with me, they'll fall for the exact same problems more often than not.
Yeah, and that's, I learned that lesson the hard way in my due diligence days, especially in hedge fund space, where nobody comes across as a moron. Like everyone seems pretty damn smart, and everyone has a investment process and systems and teams and pedigrees and all the things. But then you realize that most of those funds don't do particularly well. And then you look at the institutional investors, leave aside the fund of funds, and I was certainly part of the problem for 10 years, but beyond them, and that phenomenon has more or less disappeared, thankfully. I mean, there's a few survivors, but whatever. But endowments, foundations, insurance companies, OCIOs, pension plans, the generous thing to say is that a number of those groups can actually do a very good job in serving the specific needs of that institution. So when you think about a college endowment that has different buckets that it needs to fill, keeping the lights on, funding students, funding research, indefinite legacy assets, things like that, they can very intelligently bucket things out and find appropriate investments. And, some of these, a lot of them do just fine. And you don't have to be David Swenson and Yale and that innovative to get that done. You can be, and maybe that's a net positive. So, there's lots of good things to be said about, the well-run institutional investors that are out there.
It's like their goals have already been set by someone else, right? So it makes it a little bit easier of like, hey, we don't have to come up with the goal. The goal is right there on the outside of the building, so to speak.
Yeah, and potentially it's possible to be a little less kind of sort of impetuous about decision making. Number one, it's the goals of the institution; it's not your goals. Two, it's committee based, and so it's just not up to one person. That said, there is academic research on this, on institutional investors. And guess what? They chase returns.
Yeah.
They chase returns every bit as much as retail investors. I'm not going to throw the GameStop, Robinhood stuff into the mix but like generally speaking, you look at the behavior of quote unquote sophisticated, smart money, sophisticated institutional money, and I mean, I haven't really had much of a window into this world for a few years. I mean, I had a window for 20 years, so I saw a lot, but I'm not fresh on the topic. You are. But generally speaking, what I saw bottom up firsthand, I know the plural of anecdote is not data, but I have a lot of anecdotes. But then you look at the academic research and you can see that pension funds chase returns as much as like the guy next door.
And then you have the concept of right, like we're within our framework. We're having funded contentment at the endowment level, but oh crap, the other 10 Ivies just beat us for the last 3 years. Now they beat us for the last 5 years in terms of endowment performance. Someone there's gonna be like, this committee's out, right? So it seems like a mismatch there of like they're trying to just do what they need to do for their endowment, but they're also in this never-ending race of like, we want to be the top of the performance capsule for the endowments in our league, so to speak.
Yeah. No, that dynamic exists, and it's like take a coach in MLB or NFL, and if they don't have the support of ownership and they're being judged on just one season's performance, where in the near term of any asset volatility reigns. Yeah, it's hard to put a true longer term process in place when you're on the hot seat, and then you have to either chase the hot performance or at minimum mimic what others are doing or the others you perceive to be playing a winning hand.
How do you view, this gets back into the investment specifics, but even either in your past life or in your current life in terms of how you're doing it? I've come up with this plan, or I'm going through the planning. We're doing great. This one piece of my plan isn't working. It's not giving me the contentment. It's causing me stress. Right. And I'm thinking more of it as one of the funds in a portfolio, but
Yeah.
whatever it might be, like how do you view that of like, when do I get out? When do I pull the trigger?
Yeah, to me,
The ripcord, not the trigger.
right. So the concept of funded contentment isn't really relevant at the level of these portfolio decisions. However, I'll call it the happiness equation which is that happiness equals reality minus expectations. And so, the thesis of the investor's paradox, which I wrote 10 years ago, is that, and that was based on roughly 4,000 manager due diligence interviews.
I got to go read that one. I'd forgotten about that one.
How dare you?
How dare you? Apologies. Worst prepared host of all time. 2 books. What? I think there's actually 3, right? Didn't you do one with the what would you invest in or whatever?
Yeah. The publisher might call it How I Invest My Money, but
yes,
let's just call it What Would You Invest In, and make it into a game show.
Right.
Look, Jeff, the upside here is that you definitely owe me a drink. So
for sure, at least 2.
No. So yeah, the investor's paradox was based on really, close to 15 years of manager due diligence, starting at Morningstar in the mutual fund space, and then going to actually be an actual allocator of capital at Mesirow and elsewhere. And, just reflecting on wins and losses and good decisions versus bad decisions, and, taking into account Kahneman and Tversky and other elements of social psychology, including this book, The Paradox of Choice by Barry Schwartz. which is where the name of the book came from, The Investor's Paradox. And the main thesis of that, and it sticks to me today, and because I think it's directionally true, which is that an investment that meets your expectation is a good investment. And if it fails to meet your expectations, then it's a bad investment. Now, good or bad outcome, there's a lot of reflection to engage in terms of like, okay, how do you form those initial expectations? How do you memorialize them? How do you make observations, fact-based or evidence-based observations over time relative to those expectations? Assuming that you're not perfect at your job, how do you update those expectations? And so, to your question of, when do you boot something? Headline, I mean, there's a lot of work to be done, but the headline is, if it's failing your expectations, then it should probably go.
Which doesn't work too well in the investor world, because their expectations are nearly always way too high.
Yeah, which is why most people suck.
Yeah, because they'll see like, oh, this thing returns 12% a year. I'll probably do 14 when I invest in it, right? And then it does 10, and they're upset.
Yeah, so Natixis, big asset manager, they do a nice report every year about the wealth management industry and advisors and investors, and they do some sort of survey on, with thousands of respondents. I've never seen the methodology, so I can't say it's robust, but they do it every year, and they talk to a lot of people, and they say, well, what are your ongoing return expectations for your portfolio? And I think in the 2021 or even early 2022 version, the average retail investor, and it's not, they say high net worth, so people with, or at least mass affluent, more than $250,000 in investable assets, the number was like 14%. Their forward-looking return expectations were 14%. And the number is ridiculous. It doesn't square with anything that we learn from market history. The average expectation for a financial advisor was like 6 or 7%. So, way to go, way to be sober.
Yeah.
But even there, and granted, yields have, a lot has happened since that survey. Yields have climbed back up, so maybe you can have pretty, slightly more generous expectations for the fixed income piece of your portfolio. But expecting 7+% returns in a 0 or 1% rate environment. Okay, well, where are you sourcing?
Yeah.
Where are you sourcing? What must your expectations be for the punchier part of your portfolio, in terms of small caps, in terms of venture, in terms of certain punchier alternatives like crypto? Like, what are your expectations there to balance you out to get you to a 7%? The point is that the data is fascinating, and this is very much an expectations game. And, back to my little diatribe about, not playing a victim and taking some form of agency in this world. Like, if you're told year after year to form and settle on realistic expectations and you don't, who's to blame other than you for your disappointment?
Well, yeah, we'll leave that one be. The someone out there, that's why you shake your fist at the sky.
Yeah.
I think Homer Simpson's dad, right?
Yeah.
Abe. What's his name? Abe.
Mm.
And so digging into that a little bit more in the asset allocation, right? In the geometry of wealth, talk a little bit of, that's the biggest. I liked your analogy of like the restaurants, right? Like, it doesn't matter what you choose on the menu. If you choose Mexican food or pizza, you basically know, right? You lower the dispersion inside each menu.
Yeah.
Did I get that roughly right?
Yeah. I think I hadn't thought about it, but I think I was talking about the food court at O'Hare.
Yeah.
There was a point where I was traveling every week for work, so it's like I knew that food court too well, and it's like, give me the Tortoise, the Rick Bayless place off to the side versus the McDonald's.
But to me, it's more important. Like, what if the one you chose is poison, right, and has this 70% drawdown? So to me, like and back to your dimensions, I need something I can save that protects me that also can provide return. So, right, there's a lot of these blended portfolios out there now. Like I'm putting, I'm putting stocks with managed futures that do well in a crisis. I'm putting stocks with long volatility. So I'm just curious if you like, part of me, if I go down this path, I want funded contentment. It's really important that I have this pretty stable piece. That's my core investment theory. Or would you say, it doesn't really matter as long as you know what you want, you kind of build what you want to get there?
Yeah, I mean, I don't know if we're thinking about this in the exact, I don't know how broad a range you're thinking about things. Look, we can, like, let's keep it like in the power alley or in the fairway, to start in terms of stocks, bonds, cash, maybe, throw in your illiquid real estate, like your home or other real estate investments. And then you layer into hedge fund strategies, long, short, or arbitrage, or futures, trend following, momentum type stuff, illiquid venture, angel, private equity, private debt, venture debt. Like the world's our oyster, right? There's a 100 different things to do. I think those comments I made about, once you've chosen the restaurant, there's relatively little dispersion within the menu. So, if I want broad exposure to global equities, do I buy the S&P 500, which isn't, international, but, some meaningful percentage of revenues of those companies come from overseas markets? Or do I buy VT, the Vanguard ETF with 19,000 securities, like from all over the world? To me, that's an uninteresting, not difficult problem to solve. And I should have, and we're talking now in terms of professional investors, you should have a reasonable expectation for what that equity sleeve can do. And if you built your expectations based on kind of 2009 to 2019, then I don't know what to tell you. Like, it was great
in the NASDAQ,
until it wasn't. In terms of having other pieces to your portfolio that are quote unquote safe, like, so short-term bonds, higher quality bonds, government, as well as just plain old cash instruments, like, okay, that's the restaurant you're in the cash instrument, and you might fight for a basis. You could find a money manager in the muni space who's able to give you a little extra juice because he picks bonds better than the next guy or something like that. But like, you're in the short-term muni restaurant. The menu's really quite narrow, and like, even if I remember going back to like my Morningstar days, when you take some of those lower volatility categories, the difference in absolute return between like a 1-star and a 5-star fund is negligible. It's like basis points. That's kind of what I was getting at in terms of asset allocation coming first. Like, sure, you can be like, oh, okay, like I'm going to have a crypto allocation and I'm going to make it 35% of my total net worth. And it didn't work out as I had hoped. Well, okay, I think you've made a mistake, not in choosing crypto for your asset allocation, but putting a third of your assets in it.
Yeah. I was coming at more from like, most everything we just talked about, I would call like offense, right? They're there to give you a return. And very few people think about the defensive part. Like, what do you do?
Well, I talk about cash and munis. Like, how more defensive are you? Like, what are you?
Well, things that actually, like long volatility, things that actually pay off as markets decline, right? Things like
but you would call long volatility a safe asset?
Not safe, defensive.
Okay.
Right. So, right. It just fits in with your whole thesis of like, I want to have this whole piece that's there for what I need it for. So to me, like, okay, I want something I can count on structurally that pays off in a down market where that's there to keep doing my saving and my spending and my giving. Right. And it's a little counterintuitive because you say, why would, and the rest of the time it'll be performing negatively, right? But so you say, what counterintuitive, why would I add something that has a negative return? But it's just for that point, just for when you need it most, it's going to pop in there and keep you at this funded contentment.
So I invested in long vol, short vol, vol arb strategies for years. So I understand the point. The word defensive, I also is a good
Offensive.
word. No, but I'm not offended by defense, but I'm not, no offense with defense. Defense is there's a value judgment to that. I think you could start more clinically and just talk about lower correlated or negatively correlated assets that, help you. There's also a question of and also, like, these are open-ended questions that aren't tied to goals. So if I'm retiring and if I'm 30 and thinking about retirement versus I'm 60 and thinking about retirement, what's offensive and what's defensive? Actually, those would mean different things. So risky versus unrisky assets, like risk is flipped depending on your time horizon. So, when you're 25, bonds are pretty risky. Because the chance that you're going to be able to grow your capital to meet your longer term needs, so that at some point you can replace your human capital with financial capital, you're taking an enormous risk with that fixed income allocation. The other thing I'd mention is that just from an individual manager performance, if just having seen vol funds over the years, some show up in the way that they should and others don't. We had some vol pieces in 07, 08, 09, and I led the diligence on a Asian based vol vol and vol arb fund, and it was up like 85% in 2008. So our Asia investment book was actually like flat to up, notwithstanding all the equity exposure we had. So, bully for us. But we also had some other vol investments that were just almost by their very nature complicated, trading oriented, and guys got upside down and didn't give you the protection that you would have wanted at those times. If it's sort of I don't know if index is the right word, but just sort of a straight up, like, okay, I'm just gonna futures.
Buy puts right. It's the more structural in this, what we're talking about, the better, right? The more like, if it goes here, this is the structural payoff here.
Exactly.
But also that is done very poorly this year, actually, because it's been very highly priced, and there hasn't been a second leg down, or hasn't been much fear, even though we've been down. So a lot of that structural stuff hasn't paid off. So
there you go. So
it's harder than it looks.
Is it defensive?
Yes.
Would you?
Yes, defensive, but in that case, some offensive defensiveness. We'll let you go here in a sec, but any other thoughts on shaping wealth? I think we touched on each of the pieces there.
No, I've enjoyed this conversation. It's fun to kind of put I don't know if this, I think for your world and your other guests and listeners, this is like, probably kindergarten, me talking about investing in markets, but like,
No, I love it, because I mean, these guys they're appealing to the RAs, they're appealing to the family office, who eventually that end investor needs to believe in this hedge fund and how it fits into this overall piece of the puzzle for them.
Yeah. So to me, it's why I position Geometry of Wealth as a prequel to the Investor's Paradox, because I wrote a book about investing, and I was in some ways unfulfilled with like what I came up with, because I realized there was a whole set of questions that should have come prior that I probably couldn't have gotten to had I not written the Investing First piece. So the Geometry of Wealth is a prequel, and so I can try to boil the ocean on what does it mean to be wealthy, what's important in life, and then within that context, well, how do you set your goals? How do you think about good versus bad decision making? How do you make good versus bad investments within that framework? This has been amazing in terms of being able to say some things that I'm excited about with shaping wealth, but I'll just say that the appetite for behavioral advice, behaviorally informed investment advice, including, portfolio decisions, it's just, it's ripping. I think in light of the macro picture, which is I was going to say fun. I shouldn't say that. That might affect. It's so fascinating what's going on in the world right now. There's so many different pressures, going one way or another. And then you combine that with the amount of information and choice that the everyday person, even super smart people, are having to deal with. The opportunity for financial advisors to make an enormous positive impact in the lives of their clients has, I think, never been more profound. And, hopefully I'm building something with my team that helps those people a little bit.
I love it because I always give RAs a hard time. I'm like, come on, you don't pick investments anymore. You go golfing, right? You basically are just a relationship person. You go golf and get the client in and then have your team do the investments or whatever. But this is even better. Like, hey, if I'm an RA now, I can take offense to that. Be like, no, I'm helping them be content with their whole plan and doing all this work. It's not just about the golf. It's allowing them to be able to go out and play golf.
Yeah. So, look, there's nothing wrong with building a business and making a great living, but where we're seeing a lot of the juice is in coaching. So, the arc has gone from, brokerage, even before investing, it was just buying and selling, Blue Horseshoe loves Anacott
Yeah.
Steel. Like Bud Fox was a financial advisor, right?
Yeah. Right.
So you move from there to the late, the 80s and especially into the 90s, allocation, portfolio theory, fund selection. You also had like E-Trade and things like that pop up. And, so now it was about allocating and investing, and then financial planning, which has sort of been around for a little bit, but not that long. Really didn't come into its own until the aughts, and especially hasn't become this massive business until after the GFC.
And they were kind of two separate registrations even, right? Like I'm a certified financial planner or I'm a registered investment advisor. Like
there's, like that, the whole.
Aren't those, and I think the normal everyday guys, like, isn't that the same thing?
Well, like I remember someone put out a tweet and like they just listed all of the different things you could be, and like, financial advisor, financial planner, wealth advisor, investment advisor, and you could be a CFP, you could be a SEMA, you could be a broker dealer, you could be an RIA, you could be a hybrid.
Yeah.
And the punchline was, are we at all surprised that people are not only confused but like unsatisfied with the services that you money people are giving us? Like they're not going to make a distinction between Jeff and Brian and the next guy. They're just like, oh, okay, you guys are just, you're just trying to make a buck off of me.
We got our pod title there. You money people, right?
You
money people.
Yeah, that's from my grandmother. God bless her. She's long since passed, but she was big to use the phrase "you people."
Awesome. Cool. Thanks so much for doing this.
Absolutely.
Thank you.
Okay.
Talk soon.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.